Welcome back, traders and investors, to the final segment of the All About Crude Oil show. And we have a couple special guests on in the last segment here. Patrick DeHaan, Senior Petroleum Analyst with GasBuddy.com, and Collin Eaton, Energy Reporter for the Houston Chronicle. Gentlemen, how you doing this morning?
Doing great.
Okay, let's start out with GasBuddy.com here, and tell us about the site and what you do on it.
Well, you know, the site is built predominantly so that folks can report prices to us and help themselves by finding the cheapest gas in their area. So we have a lot of volunteer price spotters across the United States and Canada. We track gas prices in each state, and unfortunately this is the time of year when we start to hear motorists gripe, but that's the sole purpose of the website, finding cheap gas.
And what are the primary factors you utilize when determining the future price of gas, and do they change over time?
Oh, certainly, absolutely, and it even shifts day to day on the factors that we're really looking at. I mean, when it comes to factors driving prices, you have to look at everything. You look at the economy fundamentals, certainly geopolitical tensions. I mean, we could go on with a laundry list of what we're looking at. Really what's driving prices now, what we're most focused on, is the EIA data that comes out on a weekly basis, as well as what's happening at the refining level. It seems like geopolitical tensions have quieted down. Crude oil inventories are ample, so a lot of eyes right now on that refining level, and that's really what we're staring at most.
Collin, you're there in Houston, writing for the Houston Chronicle.
Yes, sir.
Yeah, Texas, one of the largest oil-producing states. I'm sure Alaska cranks out is there as well. Let's talk about the effect of falling oil prices just on the overall Texas economy.
Sure. Well, falling oil prices have led a lot of Houston-based oil service companies to start announcing laying off jobs. Oil producers are cutting capital expenditures. I think across the U.S., it's $32 billion has been cut out, and that is certainly going to hit home in the Permian Basin, out in West Texas, and the Eagle Ford Shale in South Texas. But overall, I think the unemployment rate is, it might not be as bad as 1986, but it's certainly going to be painful.
Do you see any companies going by the wayside, or perhaps defense on default, or even bankruptcies in the oil patch?
Well, I think there have been a lot of different predictions on that, but I think people are saying that in 2016, 2017, when hedges start to run out, the high-yield debt that these energy producers have taken on, $200 billion, something it's 18% of the high-yield bond market, that's going to certainly come into play. We could see a wave of defaults, but we're also hearing from private equity companies now looking to invest in distressed debt, and so really we're kind of looking at a mixed bag.
And if you talk to the average guy on the street, $50 crude, I mean, is that just an aberration? It's going back up into the, 60, 70, or 80s, or are they worried about it falling down to the $25 range?
Well, it's, I think there's a debate among market participants right now what the inventory data means versus what the falling rig count means. I think, people on one side are saying that production is going to fall, and that could help lift oil prices. But, I think a few of your guests earlier were talking about how advances in hydraulic fracturing technology can help keep that production up. I mean, we're hearing from companies saying that we're cutting, several $1 billion in capital expenditures, but our production is going to be up. So it's an interesting question. I think as crude inventories approach the maximum level in Cushing, and we start to move to floating storage facilities, we could see oil prices come down again.
Patrick, I'm going to go to you on this. It seems that when oil rallies, the price at the pump goes up much faster than when oil comes down. Do you agree or just disagree with that statement?
Well, I think it's hard to prove that. There's a lot of anecdotal stuff, and of course motorists this time of year are saying prices always go up quicker than they come down. But well, let's point out that just 2 days ago we saw the spot price of gasoline along the West Coast spike 27 cents a gallon. That's not hitting the pump all at once. That's actually taking a few days. But certainly, I think there is some proof that prices do come down a little bit quicker. I mean, prices go up a bit quicker, but it really has to do with fear. You see the market go up quick, and stations on the downside do take a little bit more of their time. That's when they're making more of a profit. So they're not going to shoot themselves in the foot by delivering that decrease overnight, because a lot of the time they're using that profit to offset what they were losing when prices were going up. So it's give and take. It smooths out the roller coaster ride.
I was in the car with my daughter the other day, and she's 22 years old, and she was looking at the price of gas, and she says to me, "Can I just buy a bunch of gas and store it?" I mean, because from her historical perspective, I mean, she's in $4 gas. I mean, are we at levels now that we won't see for quite some time, or should I tell her just hold on? You're going to see gas if crude goes to $20-25. Aren't we going to get under $1?
Well, I think under $1 days. That's a tough question. I would say those days are over just because of the overall increase in oil demand and how things have changed. I think in the background, though, we're looking at what's happening in Cushing. All of a sudden, stocks are beginning to build. Crude inventories are well over 400 million barrels. The EIA keeps saying they're the highest level in over 80 years. They're probably the highest level ever. I mean, their data only goes back 80 years. But we're looking at exceptionally high crude inventories, and it's not like refineries are mopping up the mess there. They continue to see low utilization rates as they carry out maintenance. So I think we might see a sustained period, be it 2-3 years of low prices, and if these prices for oil, rebound enough to say 50 or 60, then that'll keep producers a bit happier and online. What you're seeing now is not major wells going offline. You're seeing the itty-bitty wells that don't amount to much. We're still seeing an increase in domestic production. So I think long term, we're still looking at a situation where crude prices may be, what we would call a little bit depressed because of production numbers.
Collin, I want to switch gears a little bit and talk about how falling oil prices are affecting financial markets. Can you give us your take on that?
Well, as I mentioned earlier, the $200 billion, increase in high-yield bonds for the energy markets. Basically, I've been hearing that that this could spur fear in broader bond markets, and but we'll just have to wait and see. That's a little bit out of my area of expertise.
Okay, let's go back to, we're talking about gas, we're talking about oil. Let's talk about the outlook for natural gas. Patrick, is that something that you follow as well?
Yeah, not a whole lot. We predominantly focus on diesel and gasoline. Natural gas, not to go too deep, but it's been interesting here. You have the U.S. as a superpower of oil production, and now natural gas enjoying some of the cheapest prices on the planet, really. That's about all I can say on that.
And Collin, you have any comments on that?
I'm sorry. What was that question?
Regarding natural gas, is that a big segment of the Texas economy as well?
Oh, I think so. I haven't written as much about natural gas. Obviously, in the past few months, oil prices have been falling. Natural gas has as well, but I think that's a little bit out of my expertise.
All right, this is something, Patrick, I'll have you comment on this first. Electric cars and the proliferation of electric cars, probably not going at the pace that Tesla Motors would like, but, is this something that, could you see in 5, 10, 15, 20 years, a majority of the vehicles on the road, being run by electricity?
Well, the infrastructure would need to rapidly grow, and obviously with low crude prices, you're not having people clamoring for electric vehicles like they were just 6 months ago. So that posed a real challenge to Tesla because, as we've seen, when crude prices and gasoline prices are low, folks really don't care about mileage. In fact, the University of Michigan puts out a monthly study on looking at what kind of cars and the fuel efficiency that people are buying new cars, and that new car fuel efficiency is taking a hit as oil prices go down. So for any sort of electric vehicle to be, hugely successful in normal, for the norm, those folks in the middle class, you're going to have to see crude oil prices be ridiculously high to attract those buyers. I think right now it's not a whole lot of electric vehicles sales are taking place. You have a lot of incentives on some of them. It's a tough time right now, and unless crude oil prices rebound, which, as we said with production, looks like it may not happen for a couple of years, I think it's going to be a struggle for electric vehicles gaining traction here over the next 1 to 2 years.
And Colin, I'm going to go to you on this one, and getting into the whole supply and demand. There seems to be a lot of fracking and shale oil going on. Are these renewable? I mean, are they going to be able to keep up the production and the supply that's hurting oil prices, or are these kind of just short-term phenomena?
Are you talking about production of oil, or are you talking about the use of renewables?
I'm going into exploration, and for a lot of the excess supply, it's coming from fracking and other ways of exploration. Do you think that these are short-term factors that are going to eventually fade, or is something that's going to persist for quite some time?
Well, I think oil production is probably going to the growth rather is going to taper off maybe in the middle of the year, but the International Energy Agency has forecasted that production is going to grow significantly through 2020. So I think advances in technology are going to keep production steadily rising. It'll keep the per barrel cost of production sinking. I think in the short term, oil producers are looking at a 15 to 30% reduction in service costs, and that I think the CEO of Anadarko says that $70 oil could be the new $90 oil. Now I know we're not at $70 oil, but that says something about the best plays in the United States. I think a lot of the drilling is migrating there to places in the Bakken in North Dakota, or the Eagle Ford in South Texas, where oil producers can make money at $38 a barrel. So, I think while the rig count is going down, there's a lot of high grading, and there's going to be some innovations in the next few years, refracking, et cetera, that is going to help bolster that, keep bolstering. I'll draw a comparison with natural gas. 3 years ago, when the prices of natural gas dropped, rigs were coming down just as they are now, but we still have abundant, cheap gas. And
Okay. Patrick, one final question for you here. With crude, hanging out at just, $50 here, I mean, do you think that that's fairly correlating, to the price at the pump, or, could be even a little bit cheaper?
Not really. In fact, there's been quite a disconnect just taking place here in the last couple of weeks as refineries undergo maintenance. The price of crude has been going south and on some days, while the price of gasoline has been going north significantly. And this is the time of year when you see that the relationship between the price of oil and the price of gasoline disconnect. So motorists shouldn't be surprised with rising prices even amidst falling oil prices, because it's about that refinery bottleneck, and we've seen extreme cold temperatures bog down refineries in one way or another. We're also seeing refinery maintenance. Of course, that refinery explosion in Southern California really hitting the West Coast, and of course the United Steelworkers issue. Now, it hasn't impacted prices yet, but will it? That's an open-ended question. It certainly could at some point in the future. So it's all about refineries, and that's why gas prices are going up, because there are certainly plenty of issues at the refining level that are currently taking place.
We've been on the line with Patrick DeHaan. He's a senior petroleum analyst with GasBuddy.com. And also Collin Eaton, he's an energy reporter for the Houston Chronicle, giving their perspectives on $50 crude. Gentlemen, thanks for joining us, and we hope to have you back on our show again soon.
Thanks,
Thank you.